what else is happening in the markets? You touched on the yen carry trade unwinding a little bit, perhaps, and the effects and the intervention over in Japan. Maybe let's expand on that topic just a little bit, because we also called that secondary effect yield curve control, to perhaps keep the yields under check. You're shaking your head, so I'm really curious what you're thinking in that regard as well, because we're trying to interpret and understand, okay, what is happening? What happens if the yen carry trade really starts unwinding here?
Well, the problem with the Japanese yen is the yen carry trade, the real yen carry trade, actually is not unwinding, and there's little that the Japanese can do about it. In fact, that's the primary reason why the Japanese yen continues to go down. The true yen carry trade is not what you hear on TV or in social media. That's the cartoonist version that, hedge funds are borrowing cheaply in yen and then reinvesting the proceeds overseas. By far the biggest carry trade is really the Japanese financial institutions. So those institutions in Japan who have huge, enormous savings, and they have huge, enormous liabilities that they have to pay out. I mean, Japan's an aging society where almost everybody in Japan has saved their entire life. So Japanese financials are absolutely enormous. And with huge, enormous liabilities, they've got to generate returns that are going to be able to pay off on those obligations down the road. So they're always looking for yield, and you don't get it in Japan. The problem is that people forget that when you're looking for yield, there's two components to looking for yield. The first is, yes, nominal return, but the second is risk, perceptions of risk. Like if you're offered a nominal return of say 10%, but the chances of default are relatively high, you're not going to invest in that nominal return at 10% because the risk adjusted return is likely negative. I mean, that's, doing some rough calculations. So the Japanese financials have to look outside of Japan to find risk-adjusted returns that are sufficient for them to deploy their capital in order to pay their obligations. So what Japanese have been doing for a very, very long time, really going back to early 2008, 2009, 2010, in that period, is they've been moving their financial assets outside of Japan to buy better risk-adjusted returns elsewhere around the world, using the US dollar as the intermediate currency. So the real carry trade is the Japanese, in the language that people use, selling yen to buy dollars, which means the yen, as long as these Japanese financials are looking outside of Japan for opportunities, the yen continues to get sold. It's not actually sold, it's actually transferred and swapped, but the language people use. So there is an embedded sale or embedded downward pressure on the Japanese yen, so long as Japanese financials continue to look outside of Japan for those returns. And that isn't changing. That isn't going to change anytime soon, because the risk-adjusted return, according to these Japanese financials and their behavior, is pitiful in Japan. Even as the Japanese bonds yields have been rising, it isn't nearly enough to compensate for the perceived risk domestically. So as long as these Japanese financials are reinvesting and swapping into dollars and reinvesting their proceeds overseas, the Japanese yen is going to continue to go lower and lower and lower. The problem is the Japanese government and the Japanese central bank the official sector in Japan are either in denial or they're just lying to the public. They keep saying the Japanese economy has turned a corner. It has moved out of its deflationary mind. It's no longer in a lost 3 decades or whatever it was. The Japanese economy is relatively healthy and it's on the right track. The deflation is no longer a risk, and the Japanese financial sector continues to say, we don't know what the hell you're talking about. We look around in Japan and it's increasingly, it's either the same mess that it always was. It was just kind of papered over by the CPI, which was boosted by rice prices more than anything else, or it really is going back into, or the chances of it going back into something like the 2010s again, or the 1990s, probably not that far, is too high for us to want to reinvest our proceeds, even in higher yielding nominal JGBs, which, by the way, the Japanese would love to do. They've said over and over again, repeatedly, we'll buy the JGBs at a higher rate once the Bank of Japan stops hiking rates. So the Japanese carry trade is not what you hear in social media. It is simply in many ways, it's a commentary on the insider view of the state of the Japanese economy and the rest of the world to a certain extent, because, risk-adjusted returns are also a global phenomenon. And that's not going to continue, or it's not going to end just because the U.S. government partnered with the Bank of Japan to make a show of intervening. I mean, the U.S. selling euros to buy yen. I mean, come on. It's another symbolic operation whose goal is to just try to placate the public in the short run.
It is interesting what is happening there, especially that selling euros. Like, were they trying to? What was the intention there? Like, if you were to interpret Scott Bessent and
again, pure symbolism. I know people they have trouble thinking that's how the government operates, but the government operates on symbolic fashion like this. There is no reason for them to sell euros except for the fact that they did not want to be. They didn't want 100,000 news stories and social media posts about how they sold the dollar to buy the yen. And it was transparently stupid. So selling euros to buy yen was simply a political symbolism in this case. We got to do something. We got to pretend that we're doing something big in the marketplace. But you know what? We can't sell dollars because that would send the wrong message. It really is it's all about messaging. And once you realize that what government programs are, at least in the front, are all about messaging and symbolism, this stuff starts to make sense. And again, it didn't really work. The Japanese yen was at 164. Yeah, it popped up all the way to 156 or so, but it's almost back to 160 already. So these things have a very short half-life because it doesn't really change. I mean, a symbolic effort, even if there is real money behind it, it doesn't change the fundamentals. And the fundamentals are, as I just described them, the Japanese themselves don't like the risk-adjusted returns in Japan, so they're going to seek returns elsewhere. And as long as they do, the yen is going to continue to go lower, and there's really nothing the governments can do about it.
So the Scott Bessent note in Camp David was obviously a plant. Like,
I mean,
over
come
my
on.
shoulder. That was hilarious.
That thing
I
was,
had to laugh hard.
it was so staged, right? I mean, it was a note that's buy Japanese yen.
Buy 5 to 10 billion in Japanese yen. Like,
yeah, then he gets on TV and he says, the market's going to come around to the position that the Japanese economy is in the right track, and the prime minister is so popular, and the marketplace is okay. You got to say that. We realize that, but it doesn't mean it's true.
No. Jeff, you seem to be a cool cucumber about the bond market in general right now, what we're seeing. The question is, like, what would make you nervous? What would sort of think, okay, this is it? Like, maybe 6% bond yields, not trying to put anything in your mouth here, but I'm curious. Like, what would make you say, okay, something is definitely broken, this is not normal anymore? Really curious.
I love that question because that's exactly how we need to be thinking. We are always looking for regime changes. Something that indicates, and again, a regime change is not like flipping a switch. It's not something that happens overnight. So it's understandable why people would say, okay, the 30-year long bond's at the highest nominal rate since 2007. That sounds like a regime change, except like I said before, we went through this in 2023, just a couple of years ago, and it didn't represent a regime change. So we're always looking for clues and evidence for a potential regime change. And in this case, what we would need to see is a lot of things outside the nominal 30-year rate. So if the 30-year rate is going up, and we think that is a regime change in terms of the market position, I wouldn't necessarily think it would be about inflation. It would be more about growth opportunities. But either way, if it was inflation, if it was the marketplace saying, you know what, I actually do care about the 40 trillion in debt. What we would need to see is, first of all, those spreads that I mentioned would have to start rising in convincing fashion, not just fluctuate a little bit here in the short run. So the 30-year to 10-year spread, which again, as I said, is historically low, we would have to see an aggressive move where the market actually is demanding more return to hold 30-year paper versus 10-year paper, or 30-year versus 5-year or 30. It doesn't matter any of these spreads. We would also need to see all the related marketplaces, including something like interest rate swaps, which is the interest rate swap market is probably the one marketplace that people don't realize. They don't really know it's there. They don't really know what it does, but they don't realize it is the backbone of all credit markets. In fact, the swap market and the swap curve is probably, I would argue, and I do argue, that it's more important than the Treasury yield curve. So what you would need to see is the marketplace, broader terms, not just Treasury market, but the broader marketplace begin to embrace either an inflationary posture or, hey, we do care about the Treasury debt, and we just see no sign of that anywhere else. And as far as inflation goes, we know nothing's ever 100%. But we know with as close to certainty as you can possibly get in a complex, uncertain world, the market does not see inflation risk. We have a number of market signals for that. The flat yield curve is one to start with. The Treasury inflation protection securities market or TIPS, zero inflation risk out of that. We have inflation swaps. So we know for sure that the rise in long-term interest rates is not inflation. So we can cross that one off our list. And so if we were expecting inflation risk in the long end of the yield curve, and what we would expect to see is those markets would reverse course and we start to see more more compelling information, more compelling evidence that the position on inflation risk would be changing. And they would have to change a lot because, like I said, the marketplace for inflation is dead sure there is no inflation risk, and especially in the long-term future. So basically, the entire yield curve situation, everything along that goes along with it, would have to reorient itself in a convincing fashion that it's not just some short-run fluctuation. And again, you see no sign of that. So you mentioned how I'm pretty complacent about the bond market. It's not complacent about the bond market. It's looking at what the bond market is saying is the biggest risk. And the biggest risk is not rising rates. The biggest risk is the economic consequences of a weak economy, not just in the US, but around the rest of the world, getting hit with an energy shock that shows no signs of letting up and is going to continue to create hardships and pain all around the world, in the United States, across Europe, the emerging markets. I mean, food prices, food possibilities, shortages. There's enough downside risk to worry about that you can easily interpret, or at least easily corroborate what the yield curve signals are telling us. Yes.
Allow me one last question. Obviously, something broke here at the end of July because gold mean revert just went back parabolically higher. Actually, if I look at it, it's a 10% move again for the precious metal. I think is a massive move. But the question though is like, what triggered that? It feels like, and that's my interpretation, Jeff, and that's my last question as well. This is the second time today that we're seeing the government intervene and do something. It was the on the yen side first, the currency side, now on the bond market. Twice is not really a pattern yet. Don't get me wrong, and there were minuscule moves. But should we be prepared for bigger intervention or something? Because if I just look at gold, like something is happening, something's changed yet again. So I'm trying to think, okay, maybe twice is a pattern here. And I'm curious, maybe as a last question here, Jeff, what are your thoughts on that? Should we be prepared for bigger intervention?
Yeah, I think that's part of it too. But it's not necessarily the intervention. I think the importance, if the Treasury Department feels that it has to put out these symbolic, the note on the debt. I mean, if they feel they have to do something so transparently obvious like that, what does that tell you? It tells you that they're worried about something too. So if you start to see governments intervene more frequently, even if it's just symbolic intervention, that tells you that even these incompetent fools are thinking, uh-oh, something's not right here. And so the appeal of gold is as the ultimate safe haven demand. Hey, if governments are getting nervous, if governments are starting to panic a little bit to the point that they keep doing these symbolic interventions, what are they worried about? Well, I mean, I think the marketplace knows more than the Treasury officials. But what it becomes is it becomes confirmation that there is something to be worried about, and therefore the demand and appeal for safe haven goes up. And I think gold prices were oversold to begin with. I mean, gold got hammered. I think it got dragged down with silver. So there's a little bit of overshooting on the downside. So there's positives there. But really, I think that's the way you interpret interventions, whether from the Federal Reserve or some central authority. Isn't that they're gonna destroy the currency? It's that they see something too, and if they see it, then it has to be serious enough because they're pre-programmed to ignore basically everything up to the end where it really becomes obvious. That's the way you always look at rate cuts. Rate cuts are not stimulus. Whenever a central bank starts cutting rates, it's a reaction to weakness in the real economy that has gotten to be so weak and so real that even incompetent central bankers are reacting to it, which is why you see the yield curve behave the way it does. Rate cuts always trigger bull steepening because the market realizes if these idiots have figured it out, then it really is happening and it really is true. So government interventions are confirmation that, in this case, something isn't right, and something isn't right in such a substantial way that even they do these stupid, ridiculous things that they feel they have to, they have to make a big show of doing something because there's something to be done.
Jeff, very last question. I know I'm over my self-imposed 30-minute limit already, but it was a question that actually the audience sent in because I'm going to interview Ron Paul next week at his home, and one of the questions was, and it's really fitting today, is the Treasury trying to make the Fed obsolete, and is it a bit of a power grab that we're seeing as well? Or is the Treasury trying to make the Fed irrelevant? I
mean, I don't want to go too far, but there is definitely you can feel that there is definitely something shifting there where the Treasury Department is trying to exert more authority in ways that are, I don't want to say stepping completely on the toes of the Fed, but kind of intervening at the edges in areas that used to be left alone to the Federal Reserve. And I think it is a political move to try to circumvent the Fed as much as possible, but again, doing it in more symbolic ways to try to talk to the marketplace more directly. I think that is definitely the case. And I don't think we should be surprised about that, given the fact that the President Trump has been pretty outspoken in his distaste for Federal Reserve policies.
Yeah, it is an interesting development because, as you said, it fits the narrative, right?
Absolutely.
So, fantastic, Jeff. What a wonderful conversation. I could pester you with questions for the next 2 hours here, probably. But where can everybody else, or where can our audience find more of your work? Where can they follow you?
Just look for Eurodollar University. I'm usually on YouTube. There's daily videos there, or Eurodollar.university, the website. Eurodollar University, you'll find me.
From October 9th through 12th, I'm bringing together a group of roughly 40 serious investors and financial professionals, along with some special guests and friends like Hugh Hendry and Mike Green, George Gammon, Brent Johnson, and a couple of other ones, where we're going to spend 4 days asking the questions that truly matter. What happens next? Where are the biggest risks being mispriced? Where are the opportunities? What should change our minds? And how should we think about positioning around it? This is not a conference built around speeches. It's a small room built around discussion, some disagreement, and actionable advice. So if you manage some meaningful capital, or you're seriously interested in all of these questions and finding answers to them in a very small, intimate setting, apply below.